name is Jeff Roth. I'm with Commercial Finance Advisors. We do commercial mortgages and small business financing across the nation. In this video, I'm going to be talking about solutions to being over-leveraged. Note that this is just one section of our total report, which covers basically solutions to most of the various reasons for bank decline in this market. The rest of the report can be found on our website. But in terms of being over-leveraged or having high loan to value, really the problem is sort of a double-edged sword here. I mean, the first issue is that banks pretty much have across the board lowered their loan to value standards. In 2006, 2007, pretty much everybody out there was offering 80% financing on purchases and 75% financing on refinances. And now for conventional bank financing, pretty much the market is about 60 to 65% for purchase financing and 50 to 55% on refinances. So, this alone is a huge issue for most borrowers that are seeking to get commercial mortgages. The second issue here is that while the banks have lowered their loan-to-value standards, property values at the same time have decreased, pretty tremendously across the nation. Some markets have, held their own better than others, but pretty much across the board, property values have declined. So it's a double-edged sword, and it's created a lot of havoc for borrowers out there. As far as solutions to this problem, in a lot of regards, this is a very tough issue to get over. But there are some solutions out there, and basically we're going to go down the list here. We're going to talk about most of them. So the first primary solution is, if you're only talking to conventional banks, you need to look at the government-backed programs. The most obvious example is the SBA. And with SBA, you can go up to 90% on purchases, and you technically can go up to 90% on refinances as well, even though that's a little bit harder to pull off. So you can expect to get 80 to 85% loan-to-value financing on refinances through the SBA. Huge point here to keep in mind is that if you've already talked to a couple of SBA lenders and they've declined your file, that doesn't necessarily mean that your file cannot get done via the SBA programs. Not all SBA lenders are the same. There's a huge difference in terms of what one SBA lender will consider a creditworthy deal and what another one will not. So just because you've been declined a couple times doesn't mean that you don't have a bankable deal. The key here is to keep looking and keep finding a more aggressive bank. For example, special use properties, again, 99% of the banks out there won't touch a restaurant in this market, but there are a few banks out there that actually like that asset class and will actively fund on it. So you just need to find the right bank. Another solution here would be to cross-collateralize, and basically what you're doing there is, if your current property value is a little bit on the lower side, you're bringing additional assets to the table, and in this regard, you're increasing your total loan to value. So, other assets you can use would be, land, your home. Nobody likes to talk about that, but it is an option. Second homes, other commercial real estate investments, or residential real estate investments you have. You can also cross to other assets such as mutual funds, etc. So you can get pretty creative with that, and a lot of times by offering additional assets, you can sweeten the pot enough for the bank to want to do your transaction. Another option here would be to simply pay down your balance. For example, if you're currently at 80% loan to value, and you found a bank that wants to do the transaction, but they're only willing to offer you 75% financing, you could consider paying that 5% down and getting your loan done. So it's obviously not an ideal situation, but in this market, it could turn a deal could help you close your loan. Another solution here would be to bring on a partner. This is often a difficult solution to get done, as it's often hard to find, a partner that would be a good fit, etc. But this is a viable solution. Oftentimes, you can either bring on a partner that will help you either just pay the debt down for a stake in your business or your real estate holding company, or B, to pledge additional assets that they may have. If this is a serious consideration for you, we recommend that you go to our section of our website that gives pretty thorough description of the advantages and disadvantages of bringing on a partner. Another solution here, and this is really a completely new solution, probably really hasn't been viable since the savings and loan crisis, and that is to basically approach your existing bank or lender to work with you. We're seeing more and more banks be flexible with modifying their existing loan. A lot of times the way this actually gets done is they're willing to offer you reduced payoff if you can refinance them out. So a lot of times you basically have to approach another bank that will refinance the debt at a reduced payoff. You win because you save oftentimes a tremendous amount of money, and the bank gets you off their books, and the new bank gets a transaction at a stronger loan-to-value position. A big part of this is you need to research your bank, and we have a full description on our website on how to research banks. And what you want to do is find out if your bank is in trouble. If they are in trouble with the FDIC right now, they're going to be in a lot more they're going to be in a position where they are going to want to talk to you about this. And there's a lot of ways to do this, where you can go in. Each bank in the country has to report to the FDIC, and the FDIC in turn makes all of that information public. So again, we tell you where to go to research this, but you can go in, see the liquidity ratios, the capital reserves, etc. of your bank, and if you find that they are in trouble, again, they're going to be much more likely to negotiate with you to get you paid off. So you may consider, in terms of refinancing the debt, and this is regardless if you get a reduced balance or not. With the new bank, you may not be able to cross to another asset, but you should give serious consideration to giving them savings and checkings deposit. I mean, this is nothing new here, but it's worth mentioning that sometimes local smaller banks, if you put enough cash reserves into them, that they will be able to get over any loan-to-value standards that they have. We do still see that today happening. So keep that in mind as one of your bargaining chips, that you will bring your savings and checking accounts over, and CDs, etc. Also, you want to look at and examine how they attribute value. This is not really that big of an issue on real estate. It can be, for example, in the hotel example I just gave, how a bank would calculate value on a hotel. But for the most part on equipment, if that's a big part of your collateral mix is equipment, you want to talk to the bank and figure out how they attribute value. Some of the banks will put up like a 50% market value on it, while others will use a liquidation value. So if the liquidation value is what they're using, you're going to have a lot less to work with. So in conclusion here, this is it's a challenging solution or challenging problem to get over. You need to be creative, you need to be thorough, find more aggressive banks, bring on partners, etc. But if you are creative about this is a problem that you can resolve, and you can get financing to the financing that you need to get this done. So again, note that this is just one section of our total report. This is section 5 of 15. The rest of the report is on our website, and we wish you the best of luck with your search for financing. Thank you.